tax season's coming up, and there's two universal truths. One, you're going to pay taxes, and two, you're going to get back a giant stack of documents, and you're going to wonder, what does this all mean? Well, in today's video, I'm going to show you exactly how you can review your tax return to make sure you are not tipping the IRS. Hey everyone, my name is Jacob Turner. If we haven't met before, I'm a financial planner for professional athletes and high-growth entrepreneurs. And in today's video, I'm going to walk you through the exact strategies that we use to review clients' tax returns. And make sure you stay till the end because we're going to take our review of this tax return and we're going to show you the key items you need to be thinking about so you can strategize for the following year. My goal with this channel is to help you get smarter with your money. So make sure you like and subscribe so you don't miss any future videos. Now on to taxes. Now look, you're going to get back this big stack of documents and you're going to wonder, what do all these pages mean? And let me tell you this, most of them for you, if you're reviewing your tax return, don't mean a whole lot. Now look, they need to be in there, but I'm going to show you the one page that you need to review to make sure that you're understanding what you're paying in taxes and to make sure it was done right and to make sure that you are not tipping the IRS. So if we take a look at this is what's called a 1040. I want you to think about a 1040 like the roadmap for your taxes. This is the synopsis of everything that happened throughout the past year, and it goes down and it lists out key items. And what I'm going to walk you through is the same thing that we do in our business to help our clients review their tax returns. So the first thing that we do is pretty simple. I just want to make sure that the names on the tax returns and the social security numbers on the tax returns are right. Now, look, you might be thinking, well, of course they're right. I'm going to tell you right now, I reviewed hundreds of tax returns. They are not always right. The second big thing to think about is the filing status. Now, I made a video earlier about how filing status matters with our taxes. You want to make sure that the filing status for you is checked correctly. Now remember, there's four main filing statuses we have. We have single, we have married filing jointly, we have married filing separately, and we have head of household. You want to make sure that whatever your filing status is, it's correct. The next thing that I'm always looking at is how can we reduce our tax bill? And frankly, it really depends on one of these two things. Do we take the standard deduction or do we take an itemized deduction? And let me explain the difference. Everybody, no matter who you are, gets a standard deduction. If you're single, it's a certain amount, and if you're married filing jointly, it's a certain amount. It doesn't matter if you gave away money that year, or you didn't give away money that year, everybody gets a standard deduction. Now, if you have certain deductions above and beyond the standard deduction, you can do what's called itemizing deductions. This is what we try to do with our clients. And the reason for that being is if we can itemize deductions, we can lower the amount of taxes that we're ultimately going to pay. So a big thing for you to look at is, did I take the standard deduction and did I itemize? Now I want you to take this a little bit further. I want you to ask your tax preparer, ask your financial team, why did I take the standard deduction or why did I itemize? And would be there a way for me in the future to potentially take more deductions in the following year? The next key thing that I want us to look at is dependents. So the IRS defines a dependent as a child under the age of 19 or a child that's still in school under the age of 24. And what you need to understand is there are income limitations, but you can get up to a $2,000 tax credit based on a dependent on your tax return. You want to make sure all your dependents are on there. This is one of the biggest mistakes that I see. You have a new baby, you don't tell the tax preparer that you had a new baby. They have no way of knowing. The dependent doesn't go on there and you miss out on free money. All right, so those items, I like to think of those as the blocking and tackling of our 1040. Now let's get down to the meat and potatoes, the actual numbers that we need to look at. And what you're going to see is this giant list all the way from 1 to 15 on the first page and all the way from 16 down to 38 on the second page. And we're not going to go over every single item on here, but what we are going to go over is the key things that you need to know for your return. The first one is, if you just look at section 1A, it says total amount of Form W-2 wages. All that means is how much money did you earn from your employer this year? You want to make sure that that number matches up with what was on your pay stub at the end of the year. The next big thing that I like to look at on here is all about investment accounts and retirement accounts. And this is where I see a lot of big mistakes happen. And this is where I see a lot of planning strategies missed. If you take a look at section 2A and 3A, we see tax exempt interest, qualified dividends, all the way down to IRA distributions, pension and annuities, social security benefits. And the key thing I want to point out here is on the left-hand side of this, you can see 2A, 3A, 4A, 5A, 6A. This is the total amount of income from all these different sources. Now, when we're investing money for clients, we're trying to do it in the most tax efficient manner possible, whether that's retirement accounts where we're taking distributions or money out of them, or it's taxable accounts where we're investing for the future. The key thing to understand is on the left-hand side, this is the total amount that you made in all those different accounts. On the right-hand side, This is the total amount that is going to be taxed. You want to make sure you understand what was actually made and what's actually being taxed. And this is where I see a lot of things missed. And the reason for it isn't because you don't have good people in your financial life. The reason for it is simply this. They don't know everything that was going on. Let's use an example. Let's say we did a backdoor Roth IRA contribution. There is no tax consequence from doing that. But oftentimes what I will see is on the IRA distribution tab, it will say $7,000, the max you could do in 2025. And on the taxable account, it will also say $7,000. Now, how did they miss that? Well, they missed that because they weren't in the conversation when it was happening. So you want to make sure that you understand what planning strategies did I do and how are those ultimately reflected on my tax bill. Now, what we do for our clients at Moment is we send out a tax letter every single year to make sure that the tax preparer knows what are all the strategies that we did throughout the course of the year to make sure that they're reflected correctly on this tax return. But if you're out there and you're reviewing your own tax return, I want you to pay special attention from line 2 to line 6. Does it all match up? Does it all make sense? And if it doesn't match up or you don't know what it is, ask your tax preparer. The next key line I want us to look at is line 7. This is capital gains. And what a capital gain is if we held an investment and we sold it. And what's important to understand is if we held that investment for over 1 year, it's going to get taxed at long-term capital gains rates. If we held that investment for less than 365 days, it's going to get taxed at ordinary income rates. This is really important to understand. Ordinary income rates go up to 37% on the federal side. Capital gains rates cap out at 20%. So it's really important to understand, what did I pay in capital gains? And I want you to be thinking about it like this. The best way to build wealth is to invest in a tax efficient manner, which means we want to try to reduce the capital gains we have in every single year. So if you're looking at line 7 right now and you see a big number in there better be a reason for it. Maybe you made a house purchase, maybe you bought a new car, maybe you had some big expense come up where you sold some of your investment portfolio. If not, you need to understand, why do I have this big capital gain? Am I investing the correct way to make sure I'm doing it in a tax efficient manner to build wealth for the future? Now on page 1, 2 other lines I want to point out here is lines 12 and lines 13. Line 12 shows either the standard deduction, which we talked about earlier, or the itemized deduction. What I want you to understand if you're watching this video is, why did I take the standard deduction or why did I itemize my taxes? And what I want you to understand is there a way in the future for me to take more deductions in the following year than I took this year? That's something you want to ask your financial team, whether that's your CPA or your financial advisor, whoever is helping you with tax planning. And the second thing here, and this is a big one for the business owners that we work with, is line 13 says qualified business income deduction. Now, if you are a business owner out there and you are listening to this video and you are a pass-through entity, so you're an S Corp, you're a sole proprietorship, you're a partnership, most businesses out there are pass-through entities, essentially everything outside of C Corp. You want to have some big number on this line, and you want to understand what the calculation was done to get the number on this line. And the reason why I say that is this. The qualified business income deduction is the single biggest deduction for any business owner out there that has a pass-through entity. You want to make sure you're planning around it. And I'm going to tell you this right now. If you do not understand how this works, you need to make sure that you're asking the folks that are helping you with tax planning, what is the calculation that we're using to make sure that we can maximize this deduction? This is so, so important. And when we see business owners come in, this is the number one area that we can help them with tax planning. This is the number one area where I see them leaving money on the table, is by not maxing out the qualified business income deduction. The next big section for us to take a look at is down at tax and credits. So tax and credits is the top of page 2. I'm not going to spend a ton of time here. And when I review tax returns, frankly, I don't spend a ton of time here. And the reason for that being is most of the clients we work with are making very significant income, and they phased out of a lot of these credits. Now, not all of them. So I want to make sure I understand what credits did we get, what credits do we not get. And this goes back to, oftentimes, are the dependents right on the first page? Remember, we talked about those blocking and tackling. We want to make sure the dependents are right to make sure that if there's any sort of child tax credits, we're getting those. Now, the next big section to look at here is the payment section. On the payment section, the reason why this section is so important to understand is oftentimes your tax preparer is not going to know, unless they've had conversations with you, what you've paid in quarterly estimates. Now, a quarterly estimate is simply a prepayment of taxes that's due the following year. You do not want to be overpaying in taxes. So you want to make sure you are in communication with your CPA and you have good notes of what you paid in quarterly estimates for the year. The reason for that being is that's going to reduce what you're going to actually owe come tax season. So you can see on the payment section, it says federal income tax withheld. So what actually got withheld from your paycheck? And then there's also going to be a section on there that says estimated tax payments applied. So what that means is, what did we pay in estimated taxes? we need to understand and make sure all of these different numbers match up. The last two sections I want us to understand is the refund section and the amount you owe section. Now, there is a common misconception out there that if you get a tax refund, that is a good thing. And I'm here to tell you that that is actually not a good thing. The reason for that being is any refund you get from the IRS is essentially a tax-free loan that you gave them for the course of the year. Now, if you're like me, I don't really want to give the government an extra loan. Okay, I want to be able to keep the money for me as long as possible, especially in the interest rate environment that we're in today, where you can earn 4% roughly risk-free. The reason I say that is most people get a tax refund. They think this is a great thing, but really what we want to do is we want to pay the littlest amount in as possible to make sure we avoid any underpayment penalties. And then we want to make sure we have money set aside to pay any additional taxes that are due. This is why it's so important to be working with a team that's doing proactive tax planning. This is something that we do for our clients. We're in communication with our CPA to understand what are we making inside of our business, what are we making in our contract, to make sure we set aside money that's still earning interest. We're not giving that IRS the tax-free loan, and make sure that money's set aside for next tax season. And the last number on here is, what do we actually owe? And the reason why I put this on here is, one of the biggest issues I see is we get to tax season and somebody's surprised about their tax bill. Our goal with our clients is that they understand there's a decent chance we're going to owe some money. But remember, we got to keep all that money for as long as possible before we paid it. And also remember, we usually have it earmarked in a separate account. So in their mind, this money's going to go to the IRS in the future. There's going to be no shock and awe when this number comes back. And what you want to avoid, whether you're a business owner, whether you're an athlete, whether you're a key employee, is you do not want to get a tax season and a week before the filing deadline, your CPA sends you this and you say, I cannot believe I owe that much money. Because what that's going to do is it's going to create a bunch of anxiety, and chances are you might not have the money that you owe sitting in cash, and you're going to have to make a drastic move that you weren't planning on making. This is why it's so important to be doing proactive tax planning throughout the year, so you can understand when you walk into tax season what you're going to owe. So remember, this is step one. We want to understand what are the key numbers in our 1040. And remember, the 1040, think about this as the roadmap to our taxes. So now that we understand what the key numbers look like, I want to show you how we take all these numbers and break it down into a really simple fashion for our clients to understand. Now, when we do tax planning for our clients, our singular goal is one, that they understand what they're doing, and two, that they can pay the lowest amount in lifetime taxes. And the only way to do that is for us to know our key numbers. So after we review that tax return, we say, okay, what are the key numbers that our clients need to understand? And what you're looking at here is this is the exact document that we show them. It shows what our total income is. So how much money do we actually make? It shows what our adjusted gross income is. So essentially, what are we actually going to get taxed on? Then it shows what our deduction is. Remember, we talked about itemized versus standard. This is going to lower the amount of taxable income that we actually pay. The next line on there is the taxable income. And then we have our total tax number. So it's a very simple way for our clients to understand we made X, we paid a certain amount in taxes, and what does that total number look like? The next thing that we look at is what is our marginal rate? So if somebody asked you what tax bracket you were in this year, you would tell them whatever tax bracket that was, that's your marginal rate, okay? If you're in the highest tax bracket, you say, I'm in the 37% tax bracket. But remember, the video I did previously on the buckets to this, that does not mean that you paid every dollar in taxes in that 37% bracket. You need to understand what is your average rate of taxes. Now, typically for folks that are in the 37%, what we typically see is somewhere around 30% is their actual average tax rate. This all depends on the type of income that they're earning, whether it's investment income or whether it's income from their job, etc. The next key things that we talk about are how is the money invested and how is it taxed. So on the right-hand side of this document, you can see taxable interest, tax-exempt interest, dividend income, capital gains, both short and long-term like we talked about, and carry forward losses. The reason why we talk about this so much is one of the biggest controls that we have in the investment portfolio is investing in a tax-efficient manner. And what I mean by that is, how can we invest in a way where this money continues to grow year over year over year over year and pay the fewest amount in taxes along the way? So we have to understand what these numbers are so our clients can understand how they're investing today and how it's ultimately going to affect how much money they can spend in the future. And the key here is our goal is to pay the lowest amount in lifetime taxes. Without knowing these numbers, we can never get to step two. Step two is to understand the strategy. So you can see down here, we have strategies 1 through 6. And what we try to do for clients is say, what are all the different strategies that we can do throughout the course of the year to try to lower your lifetime tax bill? Because remember, the first step of this video, we were just reviewing what we did the previous year. year. That's tax preparation. That's not tax planning. No. You have to understand your numbers on your previous year's tax return, and you have to understand what your numbers might look like moving forward so you can do real tax planning this year. I see it time and time again, guys. Tax return is done by a really good tax professional, but they're also a human being, and there's mistakes that are made. It is so critical that you have somebody on your team, whether that's you or whether that's a financial professional that you work with, that's reviewing your tax return. It's also critical to understand after you review that tax return, step 2 is to understand what are the key numbers that I need to know so I can understand what strategies I can potentially look to implement the following year. As always, my goal is to help you get smarter with your money. Until next time, my friends.